Imagine predicting the next president and investing accordingly. Sounds great, right? Today we're exploring how stocks and sectors perform under Republicans like Donald Trump versus Democrats like Kamala Harris. We'll dive into what savvy investors should watch before the next elections. Spoiler, the answers might surprise you or even shock you. The idea that certain parties are better for the stock market is age-old, but is there a truth to it? We'll explore how different sectors have performed historically under each party, what policies impact various industries, and how you can use this information for informed investment decisions. Let's start with historical performance. Surprisingly, the stock market has generally performed well under both parties. Since 1945, the S&P 500 has averaged an annual return of about 10% under Democratic presidents, compared to about 7% under Republicans. However, some of the best single-year performances occurred under Republican administrations. During Barack Obama's presidency, the S&P 500 saw a total return of 181% over his 8 years. In contrast, during Donald Trump's 4-year term, the S&P 500 returned only 67%. However, it's crucial to note that Trump's term included the COVID-19 market crash and subsequent recovery. Going further back, under Ronald Reagan's administration, the S&P 500 surged by 117%, while under Bill Clinton it skyrocketed by 210%. These examples show that both parties can proceed over significant market gains. Now let's look at sector-specific impacts. Under Republicans like Trump, energy stocks, particularly oil and gas, often thrive due to deregulation. Financial stocks tend to do well, benefiting from tax cuts and less regulatory oversight. Defense stocks typically surge, reflecting increased military spending. Under Democrats like Harris, renewable energy stocks often see a boost, driven by climate change initiatives. Healthcare stocks can be volatile, with potential for both gains and losses, depending on policy specifics. Infrastructure and construction stocks might rally, especially if large public work projects are proposed. Let's look at sector-specific impacts with historical context. During the Trump administration, the energy sector, XLE, saw a total return of -37%. Despite pro-fossil fuel policies, this was largely due to global oversupply and the pandemic's impact on demand. Conversely, during Obama's term, the same fund returned 42.7% despite stricter environmental regulations. In the financial sector, the financial sector fund returned 59% under Trump, benefiting from deregulation and tax cuts. Under Obama, it returned almost 200%, rebounding strongly from the 2008 financial crisis. Policy impacts play a crucial role. Republicans' policies often focus on lower corporate tax rates, deregulation, and free market approaches. Democratic policy is typical taxes on high earners and corporations, and government spendings on social programs and infrastructure. These policy differences create ripple effects across the market. A Republican push for lower corporate taxes might boost short-term profits and stock prices, while a Democratic infrastructure plan could drive long-term growth in related sectors. Let's talk about national debt, a very important topic. Republican administrations typically advocate for lower taxes and reduced government spending, arguing this stimulates economic growth. Democrats often supporting higher taxes on corporations and the wealthy to fund social programs and infrastructure. However, historically, the national debt has increased under both parties. The Congressional Budget Office reports that the debt held by the public grew from 39.2% of GDP in 2008 to 76.4% in 2016 under Obama, and further to 100% in 2020 under Trump. The impact of national debt on markets is complex. In the short term, increased government spending can stimulate economic growth and boost stocks. However, long-term high debt levels can lead to higher interest rates, potentially slowing economic growth and pressuring stock valuations. For example, when the United States credit rating was downgraded in 2011 due to concerns about the debt ceiling, the S&P 500 fell by about 6.7% in a single day. Conversely, markets often rally when debt ceiling agreements are reached, as seen in October 2021, when the S&P 500 rose 1.1% after a debt limit extension was approved. Regarding statistics on investing around elections, a study by UBS examined data from 1932 to 2019 found that S&P 500 returns were on average 6.5% in election years and 7.9% in the year after elections. This suggests that being invested after elections can be slightly more beneficial. However, Fidelity's analysis of S&P 500 returns from 2016 to 2020 shows an average return of 8.8% in election years compared to 8.6% in all years, indicating little significant difference. It's crucial to remember that presidents don't control the stock market. Global events, technological advancements, and economic cycles often have more impact than any single administration. Economist Burton Malkiel once said, "The stock market is a complex adaptive system. It's not Republican. It's not democratic. It anticipates and reacts to policies of all stripes, but in ways that are often counterintuitive and impossible to predict with certainty." This quote underscores that while political factors can influence the market, they are just one piece of a much larger puzzle. Looking ahead, we're entering a period where traditional partisan market theories may be less reliable. The lines between party policies are blurring in some areas, while polarization is increasing in others. Both parties now recognize the importance of addressing climate change, albeit with different approaches. This could mean sustained growth in the green energy sector, regardless of who wins. Increasing polarization on issues like healthcare and tax policy could lead to more dramatic sector rotations, based on election outcomes. The wild card is technology and AI as usual. These are reshaping every industry in ways that transcend traditional political boundaries. Keep a close eye on how candidates from both parties approach tech regulations and AI development. The approach to national debt could be a key differentiator. Republicans may push for spending cuts, potentially impacting sectors reliant on government contracts or subsidies. Democrats might propose tax increases, which could affect corporate profits in the short term, but potentially stabilize long-term debt concerns. The technology sector, now a significant part of the S&P 500, may face increased scrutiny from both parties. Potential antitrust actions or data privacy regulations could impact tech giants, regardless of which party is in power. Climate change policies will likely continue to influence energy sector investments. The iShares Global Clean Energy ETF, ICLN, saw a 140% return in 2020, anticipating Democrat-led green initiatives. However, it's down about 20% since Biden's inauguration, showing the complexity of political expectation versus market realities. So what can we do with this information? First, diversify your portfolio to help weather political shifts. Look for all-weather sectors that have shown resilience under both parties, like consumer staples or certain tech subsectors. Consider defensive stocks if you're worried about elections volatility. Look into traditional defensive sectors like utilities or consumer goods. Watch policy proposals closely. Pay attention to specific policy proposals, not just party affiliations. A Democrat might propose business-friendly policies, while Republicans might support increased regulations in certain areas. Remember, the goal is to make informed decisions based on a comprehensive view of the market and reality, not to time your investments to election cycles. Should you completely overhaul your portfolio before an election? Generally no. Dramatic moves based solely on potential election outcomes are rarely a good idea. Instead, consider small adjustments based on your risk tolerance and long-term goals. Do stock always go up or down when a certain party wins? No, there is no guaranteed pattern. While we can observe trends, many factors beyond politics influence stocks' performance. In conclusion, while politics can influence the stock market, it's just one factor among many. Stay informed, think long-term, and make decisions based on your individual financial goals. Remember, we're here to educate, not advise. Always do your research and consult a financial advisor before making investment decisions. How are you approaching your investments as we near the next election cycle? Share your thoughts in the comments below, please. If you found this video helpful, please like, subscribe and hit the notification bell to stay up to date on all things finance and politics. Until next time, happy investing and may the market odds be ever in your favor. Thank you for watching. Bye.